QuickBooks Pro Desktop 2021. Adjusting entry, unearned revenue, customer deposit with the help of Excel. Let's get into it with Intuit's QuickBooks Pro Desktop 2021. Here we are in our Get Great Guitars homepage. We currently have the open windows open. You can open the open windows by going to the view dropdown, selecting the open windows list. We're now going to open up our reports by going to the reports dropdown, company and financial. We're going to go down to the balance sheet report, balance sheet standard, changing the date up top to 02/28/21. Then I'll open the P&L, profit and loss reports, go into the reports dropdown, company and financial, P&L, profit and loss, changing the dates from 01/01/21 to 02/28/21. So there's our profit and loss. Let's go back to the balance sheet. We're considering the unearned revenue type of transaction or adjusting entry. This will be slightly different than the adjusting entry you might see for unearned revenue on financial accounting. We'll try to explain quickly why here, but for more information, remember, go back to the presentation where we entered the customer deposits, and you'll see a little bit more information on it. So we'll recap it quickly here. Notice that normally you have the invoice and then a received payment, and then you record the deposit. Now sometimes you might get money before you do the work, meaning we basically receive the payment before we do the work. When would this happen? If you're in a certain type of industry, it'll happen all the time, such as an industry where you provide like the item, or you get paid before providing the item. So if it was like a concert, then you get paid before you do the concert, and then you're going to earn it all when you do the concert. And then, or if you have some kind of subscription model, like newspapers are the classic idea, but a lot of computer subscriptions are this way now as well. If someone pays you for a year's worth of subscription, then you're going to get paid first, and you would always basically record that into, it should always be traditionally in financial accounting go into unearned revenue, and then we would determine how much of it had been earned, and then we would record the revenue related to the earnings for that, making an adjusting entry to decrease unearned revenue and record the revenue that had been earned. Another situation is like a rental company where you often get a security deposit or some kind of deposit before like the last month of rent or something like that. You have the same situation. You got money, but you haven't really given anything in return, and therefore it's a deposit. It should be basically a liability on the books until it has been earned in some way, shape, or form. Or in our case, we might have a large item that we're going to sell. The customer comes in and says, hey, I would like this particular guitar in our case. And we say, we don't have it right now, but we can order it for you. But in order to commit you to the order, we want a security deposit now. So once again, we got money before we did the work, in this case, delivering the guitar. So same thing could be done with a law firm. You might say, okay, I will go in and do this job for you, but I would like to get paid some security deposit partially first, and then I'll start working on the job. So those are kind of some situations where we get paid first. Now, normally when we get paid first, what you would like to do is go on the balance sheet. Financial accounting would say, hey, you got to record the increase in cash, and the other side would go to unearned revenue at that point until you have earned it. The problem is that when you earn it, you're going to record an invoice, and the invoice in QuickBooks is going to be linked to the customers, and the customers isn't linked to any unearned revenue account. You need a subledger to tie these things out, and the subledger for customers is linked to accounts receivable. So logistically, we want to be recording everything related to the customer in the accounts receivable account. And if I record something to unearned revenue, it will no longer be in the receivables. So what we've done here is there's a workaround to do this, and it works fine, it works well, although it's not the normal kind of unearned revenue type of adjustment that you will have, and that is that when we got the money, we applied it to the receivable account, recording a negative receivable here, which is odd. And it's not a negative total receivable. We have a positive number here, but we have a customer within that. If we look at the customer balance detail, that has a negative receivable, which would indicate that we owe them money, which we do, because they gave us money for a guitar that we haven't yet given them yet, and therefore we either owe them the guitar or the money back. So it actually works fine to do that, except that we need to recognize that really this account now is understated, and we should have a liability down here that should be recorded instead of a negative receivable. So it's only a timing difference, so it'll be okay unless we have outstanding items at the end of the point where we want to report the financial statements, which is now. in which case we can do an adjusting entry and just do an adjusting entry to break that out properly. And then we'll do a reversing entry to put it back to where it is so it works logistically. So let's see that in this account, 13,872. If I go to the reports drop down, if I go to the accounts and receivables, we're going to go to the customer balance detailed report. And so there we have it. And I'll make this as of 01/01/21 to 02/28/21. So that's going to be our cutoff date. The ending number here, 13,872. If I go to the balance sheet, we're at the 13,872. So that looks correct. Then I'm going to scan through all the activity to see if I have any kind of negative receivables. And we'll see here that we do have a negative receivable for Anderson. We have well, no, we don't. That's been paid off, so it looks good. We're good there. Anderson's good. Scrolling down, I'm scanning to see if we have a negative receivable, and here we go. There's the one with string music, has a negative amount that is due at this point, so that's the one we're going to be dealing with. So that negative receivable doesn't take the total balance down to negative, but that particular customer, string music, is showing a negative receivable. That doesn't make sense for the receivables. It should only be positive. Customer receivables mean the customer owes us money. So a negative receivable would mean we owe them money, but if we owe them money, it shouldn't be a receivable, it should be a liability. Why did we record it to a receivable? Because I want to link that payment, that deposit, to the invoice I'm going to create later in the future, and once I do that, it'll be fine. Everything will link up and it'll be perfect. But at this point in time, we have this negative receivable. So what we need to do is we need to increase the accounts receivable to what it should be, increase it by $300, and the other side should go to a liability called customer deposits or unearned revenue being the more traditional kind of name. And then we'll reverse it the day after the cutoff date to bring us back to this format, because this does work well logistically. So we're just going to keep in alignment with our adjusting entry process. We're going to make it correct periodically, and then we'll go back to what works logistically during the time period. So I'm going to go back and do this with a journal entry first. So I'm going to go over here to our worksheet. We're on number 7. I'm going to ungreenify the depreciation ones. That should be done for you already. I'm just going to ungreenify these. And the accounts that will be affected once we know what the number is pretty straightforward, although it could be a little confusing because, again, it's not a classic kind of adjusting entry. We're not adjusting a balance sheet account and an income statement account. We're just adjusting 2 balance sheet accounts, reclassifying from accounts receivable to a liability account. Again, in practice or in a financial accounting like course, it would be a more of a classic adjusting entry in that you would record all the revenue into unearned revenue, and then you would need to determine how much of it had been earned, decreasing unearned revenue and increasing the income account. Slightly different problem we have here for it. So don't get those mixed up if you're working with in financial accounting in like a course or something like that. But this, you'll see this in practice oftentimes. So we got the receivable, which has a problem, and the receivable is understated. And then we have this unearned revenue that we're going to have to set up. Now, we don't have an unearned revenue yet, so I'm going to have to set that up. So let's actually do that as we go, because I want to put it in the right order. I'm going to go back to QuickBooks. I'm going to go to the lists and say, hey, is there an unearned revenue that's just not being used that is here? It would be like a liability account. I'd say other current liability. I don't see one. Let's actually create one right now, look at the order that it will be in, and then add it to our Excel sheet. So I'm going to go to the accounts, rise up. I'm going to say new, and this should be an other current liability account. So it's going to be other current liability type of account, continue. And I'm going to call it unearned revenue, and I'll save it. Hopefully I spelled that right. And there it is. So it's going to be right after, it's going to be like the last current liability. It starts with a U, so it's an alphabetical order in the other current liabilities. So I'm going to say, all right, my liabilities are over here. Sales tax is going to be after the sales tax. I'm going to idle line here, right click, and I'm going to insert and shift down. And it's going to be unearned revenue. So unearned revenue. I could check the spelling on this side. Let's check it. Check the spelling. Totally spelled it right. And then I'm gonna make these the same. I'm gonna add the formula down. I'm just gonna copy the formulas down. So same formulas here. Okay, so then that's gonna be the other side. Now the journal entry is gonna be nice and easy because we saw that the accounts receivable was understated. We have to add to the receivable. So I'm gonna say this is gonna be an adjusting entry, ADJ7. Accounts receivable is gonna have to go up. And I'll say up by 300, I think it was. And then the unearned revenue is also going to go up by the 300. So we're increasing the negative receivable, decrease the asset. We're increasing the asset, and this should be a negative. And then we're putting it on the books as a liability. So we're taking this negative back customer balance, this negative 300, and adding it back. And then we're taking it out of the liability side. So from transaction, I'm going to record this accounts receivable up top. Let's go to the AR. Something's in it. It's right here. Something's in it. So I'm going to double click on it, go to the end of it, and say plus. And then I'm going to add this accounts receivable. So there we have that. And then I'm going to go to the unearned revenue. And I'm going to say this is going to be the credit. It's going to go up in the credit direction. So there we have that. So here's the liability. And here's the accounts receivable. Accounts receivable now at the 14,172. If I go back to QuickBooks, we're gonna have to adjust that, and hopefully this will be 14,172 after that point, and then the balance sheet will also be there. So that's what we'll do next time. There's no effect on the income statement down here. So no effect on the income statement. So next time when we add this to QuickBooks, we have a problem, however, that we have to deal with. One, when we record this transaction, easy transaction to record, only 2 accounts, but the accounts receivable is going to require us to use a customer. So we got to make sure that we have a customer to record to the accounts receivable account. Slight little glitch for us to do that, but it should be straightforward. And then we will add this to the QuickBooks file next time.